Dr. Frank's Finance World. I'm Dr. Frank, the bank, where I try to teach you something about finance so you can use it to bank money in the future. Look for and please subscribe if you will. Get the notifications when we're through with just the fundamental part here, especially when we add the part about an interesting competition we do at Colorado State called the Rocky Mountain Investment Challenge. Between the technical and the fundamental, we will have about 20 videos for you guys to look at, and we're actually getting into investments next. So we're getting more all the time. If you like what you see, you can get them. Look for the websites and so forth at the end of each of the videos and in the links. Check out the books on our bookstore. It's part of drfranksfinanceworld.com. And now let's talk about the power of DCF and how it frames the assumptions. So the assumptions you make along the way, and I'm not even sure, you kind of just say, hey, this growth rate and this multiple and this kind of stuff out there, but it really does frame the conversation for you out there. And ultimately, you can go back, and when the earnings announcements come out, you can see how much you missed by, because rarely does anybody nail it exactly, but you can see how much you missed by. You can see like, oh, okay, that means that they're selling less, or they're selling more, or they're selling more of the low profit or more of the high profit stuff, or their overhead is ballooning, or their inventory is costing, or whatever. So you become very aware of the differences in the numbers and what you expect that to lead to valuation in the future. So as news and information comes in, you can see pretty readily and pretty easily how it will impact the intrinsic value. And by watching what other analysts think, you can see how their expectations are changed. And then you get a whole picture of what the market is thinking, essentially. So framing is what they call that. We make assumptions, arrive at the numbers. Testing those assumptions is the important part. For instance, what if the firm we looked at in part 2 had a future price to earnings ratio of 32 versus 12? Well, believe it or not, the firm we were actually analyzing did have a PE of 32 instead of 12. And what does that mean? It means that that terminal value, that price to earnings multiple times those earnings in the future of 61 bucks a share or whatever, comes up with a future price now of $1,274. And when you bring that back through time, you now see that intrinsic value would be 1,452 bucks instead of 655. Quite a difference. If you've ever seen where somebody thinks that, I don't know, pick a company, some company out there, Tesla, whatever, worth $5,000, and somebody else thinks it's worth 500, the proof of what's going on is essentially in the different assumptions they made along the way. So any and all variables should be considered from a valuation standpoint. So what we're going to do here is I'm going to escape out of here, and I'm going to show you one of my previous teams. One of the things that I've done before is I have worked with student teams to go to national and international competitions, and they're called the CFA Global Investment Challenge. We won a couple of them back to back out of the Memphis area down there where they did one of the regional competitions. But one of the companies that we analyze is International Paper. And the beautiful thing about this is it's really old. This is 12 years old now, 13 years old. So it doesn't help you at all in saying, I should own International Paper. This is obviously not a, hey, go buy it now kind of thing at all. But I want to show you the process that went through, because it puts together all the points that we've talked about. And I'm going to do this one more time when I get a little more in-depth on the Rocky Mountain Investment Challenge. But at any rate, the company we were looking at many years ago was actually International Paper, and we came out with what the price was and what the target price was and why we thought it was going to be that way. Ultimately, it had better than average margins, you know, gross profit margin, net profit margin, that kind of stuff. And we thought that a reasonable multiple was either 6.9 times their EBITDA and enterprise value to EBITDA, and we thought that would give you that price. So ultimately, we just kind of gave our estimates out here and looked at some basic information about the company at the time, how many analysts covered it, whether they thought you should overweight, equal weight, or underweight it as well. We also did kind of a quick picture of timeline-wise what had happened to the company's stock price. This was an interesting time because obviously in the debacle of the bank blow-ups and stuff you had in 08 and 09, you had a lot of companies tank quite a bit in price. As a matter of fact, you had this company go from $37 all the way down to $4 a share in less than a year. And so the question is, when it's bounced back, where would you really expect it to be? Is it going to keep going up, or is this too much of a jump? So anyway, we discussed that a little bit. This is where we broke down, and I told you in the early part of the fundamental analysis, to really get a good picture of firms, you need to break it down into these segments. And these are two of the four segments the International paper did. They did industrial packaging. We told what that was. And then the end users, the importance of understanding who's going to use your product is. You can say, are they going to use more container board or bulk packaging or whatever out there? And this one segment was 38% of all their revenue. Another one was printing paper, and you can see all kinds of different things they use it for, medical products, tissue paper, and all the rest. And you can see what was happening to the sales in those areas. Industrial packaging was picking up while printing was becoming a smaller part of their operations. This is that product mix changing through time. They also did printing and publishing and supply chain solutions for people, which was 28%. It was fairly flat. They also did consumer packaging, which was on the up and up, and it was 12% of what they did, 13%. They had a forest products division, but they were selling off the land and shutting it down. We also did a geographical, and that's another way I said that you can look at different regions of the world they're competing, so you know where their business is coming from. Is Brazil going to be a healthy economy going forward? Or internationally, Europe, Asia, at the time they were talking about the BRIC countries, Brazil, Russia, India, and China, and seeing where that was going to be and how they were going to compete in those markets, because that gives you another picture of the profitability and the product mix in different regions of the world based on how their economies are doing. Next, we went into the margin analysis, this is when we turned everything to common size. When we divided everything by sales, you figured out where the gross margin is, what they have left after they pay their cost of goods sold, but it's all they have left to pay the rest of the bills. But the neat thing is, ultimately, it was starting to trend up. And that's a good thing. And compared to competitors, they were crushing them. Their gross margins were a lot better. So what this says to us is, in one of the most important segments, or overall for the industry at least, they were a much more profitable than average company. So you would expect better multiples. We looked at growth in segments, broke it down a little bit more based on segments and packaging and all the rest out there. We also then compared, once you have, and this is why when we go in and look for competitors, you can look at somebody, Target to Walmart or whatever, but it's interesting when you break it down by segment, because in the industrial packaging division, they only had a couple of competitors, and the multiples the market was willing to pay of price to earnings or enterprise value to EBITDA were quite a bit higher than they were in the other segments out there in general. And so when you looked at all this, it was one way of valuing it, which was to simply value it by the segments. And so if the average was 29 and they were a better than average company, maybe we used 30 or 32 or 34 times earnings or whatever. So anyway, it was a combination of these different segments where we came up with the multiples of price to earnings and of enterprise value to EBITDA that we were going to use for valuation. We look at the catalyst for good things to happen to the company. They thought increased consumer spending, decreased unemployment, so forth. The balanced use of cash flow and how they were getting better control over that type, the debt reduction for them. We looked at joint strategic ventures they had made with Weyerhaeuser and other companies around the world, and then whether management had been through this before. I hope what you're seeing in here is all the different things that we touched on in the fundamental analysis that we use to come up with a valuation for a firm, because it isn't just about the intrinsic value based on DCF. That's only one of several methods we could use, and that's what this is trying to get at in this slide PowerPoint here. So ultimately, we also looked at the risks. We happen to know that their wood fiber was going up by quite a bit because somebody knew somebody whose dad had been the CFO and he'd retired from the company that was selling them pulp and that wood pulp and that kind of stuff. But the employee pension plan was underfunded, which means the company's going to have to pump money into the pension plan instead of growth of the company. That's another risk you'd have to worry about. And then just what's going to happen, sensitivity to the economy and so forth. So in the end, we decided we'd come up with these multiples, the base kind of case, and then we had a downside case and an upside case on this EBITDA margin and so forth, and what that would mean profitability and price-wise to them. And the same thing down here, when you looked at multiple sensitivity, if we got the margin right, but they traded at different multiples that would also lead to different prices. And then we put together this scale of if the earnings were off a little bit, or if the price to earnings ratio, was off a little bit, we could see what that would lead to price wise for them, and whether they'd still be a good buy or not. So this is where we took our base case and we framed it. And we said, if these numbers were a little bit different, what would that mean price-wise for international paper? So anyway, they finally did the call. You can come down here and look and see the incredible amount of work that was done. There's the one income statement through time. There's the balance sheet that we did. This one turns into a percent of sales like we talked about before. The balance sheet as well, and the growth of that, what we've estimated it would be. Different valuation tables and information on that. Obviously cash flow, different ratios, price to earnings, financial strength, and so forth out there. The pension plan information, in case anyone wanted to look that up, where the debt maturity might come back to haunt them. They had it several years out, but there was one bump out here in 2018 that could be an issue at least. Capital structure, we looked at their bonds and how that might change their cost of debt versus cost of equity and so forth. Anyway, and then just some sensitivity to certain industries. In the end, we came to the call and the downside. And anyway, you can see where we even went as far as to look at the management out there and how we thought they were going to do. So it's just a pretty fascinating process to me, and it can get way, way in depth. What I want most of you to look at as the average investor is just know this. The more you know about the firm, the more you can understand how changes in the economy or changes in their business or changes in their product mix or profitability because of inflation coming in at the producer level like it is right now, how that will eat into their profitability and feed into valuation. That's what I really want you to get about this more than anything else. So, anywho, in the end, don't be discouraged. There's a lot to it, to be honest with you. Lots of things can and will change. Take your shot at it. I think that's actually important. I try to tell my students that at the very least you understand the firm better, but your best estimate, looking at channel checking and everything you can see about the firm, I think it's as good as any analyst could be if you put some time and effort into it. So compare to what the analysts think out there to see how far away you are. We used to have to, when we went to competitions, say why the numbers were different than what the analysts were and why we thought that was so. Watch for changes. You can see in the Yahoo Finance, for instance, who's changed their opinion about the earnings per share in the last 7 days, in the last 30 days, that kind of stuff. And then use historical multiples to frame possible values like we did here relative to products, competitors, and economic forces. And you can actually go to Coithin and find some historical numbers that are very useful in addition to Value Line when you're trying to frame that research in the future. So we're done. Let's see. Okay, book previous. This is the one I wanted to show you. It's a phenomenal resource. This guy is amazing. Pablo Fernandez out of the University of Navarre over there. Anyway, he's got a book. I've tracked him for a long time. And anyway, if you go look it up, it's pretty cool over here. If you put that link in here, it'll go to this valuations and shareholder value creation that he's put together for you guys. And it's free. And it really is the culmination of his research. He's published hundreds of papers and stuff, and he puts them in here about how you create value for a firm and so forth out there, the different methods people use. It just goes on and on and on and on and on, all the different things he can do. It's just really, really cool. Anyway, so when you go in here, look at it, it's really cool stuff, and it's free. You can't get any better than that. If you go all the way to the end, he has an incredible amount of charts and stuff that give valuation stuff that he's done in his research through time that can help you understand different firms and all that out there. And it is free, my favorite price. So that is the book for this time. The strategy, do this process on different enough companies that you get comfortable. It's a little different industry. It is the changes that matter when you get to valuation and earnings snapshots of time and that type of stuff. So don't forget to send emails, comments, suggestions. Be sure to ask Dr. Frank, and I will eventually do a quick synopsis on how I find firms, and that is what is next. So have a great day. We'll see you guys. Bye-bye.